Hello, very good morning to all. I'm Kelvin here again. Very good morning. Welcome to today's Daily Dose of Market Insights. Very good morning. Today will be Tuesday, the 15th of October, 2024. So as usual, before we start our Daily Dose of Daily Insights for today, let's have a quick look at the disclaimer first. All right, leverage trading carries a high degree of risk and may not be suitable for everyone. Losses can exceed deposits. This presentation is not an offer or solicitation to buy or sell, nor financial advice or recommendation for any investment product. Any forecast, prediction, projection in this presentation is not necessarily indicative of the future or likely performance of the product. This advertisement has not been reviewed by the Monetary Authority of Singapore. All right, so as usual, before we jump straight into the short-term intraday technical outlook on the broad-based cross-asset classes ranging from the major dollar pair, the major stock indices, as well as the two key commodities market, which is Gold XAU/USD and West Texas Oil. Let's have a recap first. What has taken shape yesterday in terms of news flow, economic data, and their impact on the respective cross-asset classes. So for yesterday, we do have a rather quiet US session, not much of a key data release in US as well as globally, but however, we do have a slew of Federal Reserve officials speaking, and I want to highlight one particular Federal Reserve official, Fed Kaskari. So yesterday he made a public speech. So what he also kind of reaffirmed that there will be, he see further modest cuts in the coming quarter. So what I mean by modest over here is that means lower odds of a jumbo 50 basis point cut in the next few meetings, FOMC meetings. So that is also in line with the current pricing of the CME Fed Watch 2. Later I'll flash in a while time. That market is looking at only 225 basis point cut into November, as well as December and the early months of January and March next year. And he also mentioned that he's confident about the US economy, stating that the US labor market remains strong. So that actually also kind of reaffirm the ongoing market participants' narrative of a soft to no landing economic scenario in the US economy. So how does it impact the financial markets? So for sure, it was a very positive feedback loop that is being spilled over into the US stock market yesterday after this encouraging remarks from Fed Kaskari, stating that his view that the US labor market remains strong. So what we could see is a slew of green in the major US stock indices. Both the SPX and the Dow Jones Industrial Average continued to print fresh all-time high yesterday, with the SPX gaining 0.77%, outperforming the Dow Jones Industrial Average by 0.47%, and the Nasdaq 100 added 0.82%, which is the strongest performer yesterday, whilst the Russell 2000 not too bad with a gain of 0.64%. So why the reason why the Nasdaq and the SPX outperformed the Dow Jones and the Russell 2000 yesterday was due to a very strong intraday performance by the mega cap stocks, resurgence of AI optimism play again. So if you look at the broad-based heat map, okay, let me share with you all. Okay, let me put it down. Okay, so this is the heat map of the S&P 500 yesterday. So what you could see is that a very strong performance on the mega cap stocks, them almost in the green, except for Amazon, which is down 0.68%, and Meta almost unchanged, driven by the AI leader, NVIDIA up 2.4% to fresh closing all-time high. So this was actually also due to firm-based specific positive news flow up from NVIDIA, stating that recent management comments has eased the concern about production issues, and as well as there was actually a couple of days back, there was actually the top man CEO Jensen Huang. Okay, let me highlight to you all. Okay, Jensen Huang said that NVIDIA Blackwell chip. So this Blackwell chip is actually the flagship product of NVIDIA that is driving this bulk of its revenue inflow is in full production, and demand for it is insane. So that actually create a very short-term intraday positive feedback loop into NVIDIA share price. And we know that NVIDIA is the big product of this ongoing AI optimism. So with it driving up the share price of the Nvidia is spread on to the rest of the mega cap technology stocks over here, with the acceptance only Amazon and Meta, but that should be sufficient enough to actually propel the SPX to fresh all-time high and lead to this outperformance of the Nasdaq 100 yesterday against the other major benchmarks US stock indices, given that the technology mega cap component weightage has a biggest weightage in the Nasdaq 100. And bear in mind, the Nasdaq 100 hasn't hit fresh all-time high yet. All right. So now back to the CME Fed Watch 2 again earlier on, which I mentioned. So no change in after whatever Fed speak guidance given by Federal Reserve officials Kaskari yesterday, more or less reaffirming the only 25 basis point cut coming into the next FOMC meeting right after the US presidential election on the 7th of November. That's 2 days after the US presidential election. So still having a high odds of 86 or 87% chance that the Fed will only do 25 basis point cut. So how do we know that? Very simple, by looking at the current target rate of the Fed funds rate is at 4.75% to 5%. If you look at what market is looking at, bring it down to 4.5%. So that's an implied 25 basis point cut. And basically, for those who first time seeing this CME Fed Watch 2, what is it about? So CME, the exchange, has created this CME Fed Watch 2. So what they did is that they look into account of all the current month traded 30 days Fed funds futures contract, as well as those months ahead. And from there, they have a calculation to calculate what is the implied probability based on the current pricing of such futures contracts that is tied on to the Fed funds futures rate. What is the market implying? And from there, they're able to calculate the odds of whether is it skewing towards a 25 basis point cut, hike, stamp pad, or a much more higher magnitude. So based on the current pricing right now, market is actually implying or skewing towards or favoring a high odds of 87% that the Fed may cut by only 25 basis point on the next FOMC meeting on the 7th of November. All right, and what they do is that you can look at the probability actually is not static, it's dynamic. So the current one is 87%. This data is not live, it's about 1 to 2 hours delay. So 1 day ago it was 89, 1 week ago it was 84, and 1 month ago it was only 50. And in 1 month ago, there's actually a slight chance of 27% chance of another mega rate cut of 50 basis point to bring it down much lower to 4.25%, but that has been greatly reduced as the days goes by, as more economic data and related news flow starting to seep into the market, such as Federal Reserve officials speaking. So only now a small chance of 13% chance that there will be stand pat. That means no change at 4.75%. That probability was almost the same about a week ago, which is at 15%. And if you want to see across the road, what is the probability that's being assigned to the future meeting down the road, like on the 18th of December and as well as into next year, we have this aggregated tab. If you click on this aggregated tab, it will show you the meeting, all the way meeting from 12 1 year ahead from now. That means it will stretch all the way down to next year, 29th of October 2025. So pardon me, so just to highlight over here is that the front number over here is month. So this American date, I can't change it. There's no way for me to change it to UK standard. So whatever you see is month, date, year. Okay, that's how they name the date. So it's a bit of confusion, but I can't change the date to our UK or Singapore standard. Okay, so now what we could see over here is this is the next month, 7th of November. 87% high chance to bring it down to 4.5% to 4.75%. So take a look at those number in highlighted in turquoise in turquoise blue. So that one is the higher probability. So the next one over here will be another 25 basis point cut based on the current pricing of 81 or 82% chance to bring it down to 4.25%, and another 25 basis point cut in the early part of next year, 29th of January, to bring it down to 4%. That's have an assigned high probability of 56%. So net overall, what you could see is that a series of Federal Reserve rate cut will only be baked in of a 25 basis point cut each going forward, rather than any chance of a 50 basis point cut. All right, based on such if that was such pricing about 1.5 months ago, because of much more resilient economic data coming into the US, especially the very strong, robust non-farm payroll data that was announced 2 weeks ago, that greatly reduced the chance of a 50 basis point cut for now. All right. So with this only 25 basis point gentle interest rate cut going forward, that led the dollar to be very, very strong in the last 1.5 week. So if you look at the dollar index yesterday, over here, the dollar index yesterday continues to remain positive. So it actually rallied by 0.29%, but right now it's coming very close on the intraday basis, because now very close on the very daily basis. This is a daily chart at a near-term resistance of 103.65. So basically, what is the dollar index? Dollar index is just to use as a general gauge on the dollar performance against the major currency, the dollar index. So the dollar index doesn't constitute all currency. It doesn't have the Sing dollar inside. It doesn't have Chinese yuan, and even it doesn't have the Aussie and the Kiwi dollar. So basically, it's highly weighted by these top three major currency: Euro dollar, Sterling dollar, and the Japanese yen. And the Euro dollar has the highest weightage among the three of them, and other currency as well, like the Swiss franc and the Canada dollar. So it's coming very close to a near-term resistance at 103.65, which is also the 200-day moving average. But from a bigger picture, from a multi-week point of view over here, it seems to us that this dollar index may have a chance to actually retest this major resistance zone of 105.48 and 106.37, which the upper boundary of this kind of symmetrical triangle range resistance, that is range configuration, that is in place since the high of 3rd of October last year. All right, so yeah, it may do a bit of consolidation over here below the 103.65, but thereafter it may continue this upward trajectory, given that the technicals are still rather positive. If you look at the daily RSI, coming to overbought, yes, but there's no clear sign of a bearish divergence yet. Okay, so how do we know that there is a chance of a possible consolidation below 103.65 first, which is the 200-day moving average? We can take a look at the intermarket factors that potentially could drive the movement of the dollar index, which is the US Treasury yield. So if you look at the dollar index, that has been going up since the low of September this year. It has been pushing up since 30th of September low. It has been moving in line with the US Treasury yield as well. By looking at the 10-year US Treasury yield, that has also inched up from its September low. And this inch up from its September low right now is also coming very close to the 200-day moving average, that is acting as a near-term resistance at this 1.16 level, very similar to the US dollar index 200-day moving average, which is resistance at the 103.65 level. Okay, something to take note of. So over here is to come close to this 200-day moving average resistance at 4.16 on the US Treasury yield. Okay, and if you look at the shorter term yield, the 2-year yield, it also came very close to still way above the 200-day moving average, but very close to this intermediate resistance, former minor swing low support, break turns into a pullback resistance, and now there was a negative reaction of it last week at the 4.12% level as well. And yesterday, right now during the Asia session trading, it do trade during the Asia session as well when Japan is open, and Japan market is open for today. There's a negative reaction of it on the intraday basis after hitting 4.12% last week. So that could actually potentially see at least some form of short-term dollar strength setback going into the picture by looking at the price behavior of the US Treasury yield curve that I expressed to you earlier. So now, what other news flow to take note of will be oil price. So oil actually traded lower yesterday, so by I think 1.5%. Why? Because OPEC yesterday cut its global oil demand growth forecast for the third consecutive month. So demand growth estimate has been cut by 106k barrels per day. So despite there is this ongoing geopolitical risk premium that is taking shape in the Middle East that is still fluid right now, due to this impending impending Israel retaliation attacks towards Iran that hasn't taken shape, since there was a very strong rhetoric coming out from Israel stating that they will hit Iran assets hard. Very likely it could be targeting Iranian oil and gas production except that could actually create a disruption in the Middle East oil production facility. So that by right should actually lead to further oil prices rising. But however, given yesterday's negative news flow on oil prices actually tumbled. So very likely in a very short term, because it broke below the 73.15 on the West Texas crude oil short-term pivotal support level that I highlighted yesterday. Later, we'll take a look on the short-term technical outlook on WTI crude. So very likely it may start to trade within some kind of range-bound configuration again for West Texas crude oil, at least in the short term. Okay, so that is the news flow, and as well as the respective its respective impact on the various cross asset classes that I want to share with you for today. So right now, let's now dive into the fundamentals and intermarket dynamics. So today's fundamental I share with you is more pertaining to the US stock market. Why? Because it's important, because right now we are in the midst of a Q3 earnings season, and we know that Q3 earnings seasons, very important, it may be the sole factor that drive the performance of the US stock market, despite the fact that next month we will be in the US presidential election, where it tends to increase the volatility of the US stock market negatively. All right. But however, one thing interesting I'll share with you that we know that before the start of every US earnings season, is need to take a look at how analysts actually see the US earnings season will be playing out. And in fact, this time around for Q3, the analyst expectation is not as rosy as in Q2. And how do we know that? By looking at macro micro. So this micro data is a website that I tend to use. It offers me a lot of good insights on macroeconomic data. All right, so this macroeconomic data is pertaining to the US economy and the US stock market. So this data over here is the US Economic Surprise Index that is in green, turquoise blue, turquoise blue. And the one playing out in orange over here is the US Citigroup Earnings Revision Index. So what this earning revision index is that Citigroup, they actually compile together the aggregate analyst consensus on a very broad-based basis on the US stock market. So if this particular earnings revision index, okay, let me hide the one is surprise index. I'll push it up. Okay, so what we have is over here is the Citigroup earnings revision index. If this revision index is above zero, that means there are more analysts on the average are optimistic on the outlook of US corporate earnings. If it's below zero, means analysts are pessimistic about the corporate earnings. So this data is not live. Okay, it will actually Citigroup will actually get it from a 1 day lag over here. So 2 days lag, pardon me, 2 days lag. So this will be on Friday, 11th of October, last Friday. Okay, last Friday. So it's not the live data, but based on the 2 days lag should be sufficient. So based on this Citigroup compile earnings revision index, depicted by micro database. This is a fundamental database that I subscribe. It tell us, okay, maybe I enlarge it so that you guys could see. Okay, so it tell us that analysts as a whole is still pessimistic about this upcoming Q3 earnings in the US because reporting season, because it's below zero, but their pessimism starts to be reduced as the days goes by. So previously, the previous 2 Friday on the 27th of September, it was at negative 0.27. Then thereafter on the next Friday, 4th of October, it's at negative 0.2. So it was updated on a weekly basis. And on last Friday, the negative reduced lower to negative 0.16, but it's still negative. All right, it's still negative. So net overall, what it means that yes, US analysts that is covering the US stock market, they are not so optimistic about the earnings growth in Q3 on the average. Q3 earnings reporting season that is kickstarting now in the US stock market. That means, i.e., any earnings report coming out can be easily beaten on the upside because expectation has been lowered. So if analyst expectation be lowered, the actual number could have a lower bar to beat. So once you have a lower bar to beat, it could actually create a positive feedback loop into the actual stock prices. All right. So that actually happened on last Friday, where initially the earnings guardians or the earnings outlook for Wells Fargo and JP Morgan was very weak. Okay, what's the analyst expectations is weaker. But however, the actual result is able to beat the expectation. So the surprise came in. Okay, the positive surprise came in for JP Morgan and Wells Fargo, and that created a positive feedback loop into the stock market, especially on the Dow Jones Industrial Average on last Friday, surging to all-time high. Why? Because the banking stocks in Dow Jones Industrial Average has a higher weightage over those mega cap technology stocks. So this one to stress for you all. So yes, earnings reversion index may be negative right now. That means analysts is not so optimistic about Q3 outlook. But however, the actual earning result has a lower bar to beat right now based on the not so rosy expectation of analysts. That could actually lead to a positive feedback loop on the US stock market on a multi-week perspective. As you know, the quarterly earnings result take about a month to go to actually cover, or even more than a month, at least 2 months to actually fully release everything. Okay, and with that, there was this potential positive feedback loop that could be in play due to a lower bar of meeting analyst expectation by the actual earnings result. Market breadth has also starts to improve in the US stock market as well by looking at the, okay, where is it? Over here. Yeah, the percentage of stocks in the Nasdaq 100 and the S&P 500 trading above their 20-day and the 50-day moving average. So you look at the Nasdaq 100, the percentage of stocks that are now above the 20-day MA has started to improve greatly from a week ago. Okay, previously it was at 49%. As of yesterday, it went up to 81%. So very similar for the 50-day moving average as well. Previously, it was at 54%, and yesterday it went up to 81% on the percentage of Nasdaq 100 stocks trading above that 50-day moving average. Similar as well on the SPX 500, the percentage of stocks that are trading above the 20-day moving average and the percentage of S&P 500 stocks that are trading above the 50-day moving average has improved as well from a week ago. So previous week was at 45%. Yesterday, it pushed up to 70% on the percentage of stocks above the 20-day moving average. And from last week, it was at 61% for the percentage of stocks at above the 50-day moving average, and now it inched up higher to 78%. All right. So net overall, it starts to see a series of higher low. Okay, in terms of the number of percentage of stocks trading above their respective 20-day and the 50-day moving average on both the SPX 500 and the Nasdaq 100, indicating that market breadth has improved. So market breadth improving on the SPX and the Nasdaq 100 based on the percentage of stocks trading above their respective 20 and the 50-day moving average. Analysts has a lower expectation on earnings growth for Q3, lowering down the bar for the actual result to beat. That could create another positive catalyst for the major US stock indices to actually shape higher high going forward, at least from a multi-week perspective. So overall, despite the ongoing so-called potentially higher volatility environment in the upcoming US presidential election, due to this positive element that is being played out, I share with you all, market breadth and very low ball analyst expectation for Q3, that potentially could override the negativeness of the higher volatility that's going to be in play during the US presidential election, at least from this 1 to 3 weeks perspective. That is still going to be positive potentially for the performance of the US stock market or the benchmark US stock indices in general. All right. So with that, that comes to the fundamental and the intermarket dynamics. Now I share with you all for today. Okay. So before that, let me expand my screen first so that you guys have a bigger view on the chart that we're going to cover right now on the short-term intraday technical outlook on the respective broad-based cross asset classes, starting with the FX market. Okay, so now let us start. Before we start with the FX market, on the euro dollar, let me have a quick look on the broad-based performance first. As usual, I will share with you all the 5-day rolling performance over here. Okay, so this should be today. Okay, let me, hopefully I can change the date. Okay, it's hacked, never mind. So just ignore this date. It should be 5-day rolling performance as of today right now. Okay, for 15th of October. So what we could see over here is that there is some form of dollar strength coming back into the picture against the dollar CAD and especially against the dollar against the Canada currency and the dollar against the Japanese yen. But however, the dollar still remains muted against the Aussie and the sterling dollar, but kind of sideways against the dollar euro as it continues. The dollar euro is right below the dollar index over here. Okay, so one thing that the currency that is the dollar that is outperforming against the dollar, that means the dollar pair against the dollar, that means the dollar that is outperforming the Japanese yen and the dollar CAD. Why? Because these two major dollar rate, the dollar Japanese yen and dollar CAD, is showing higher performance against the dollar index, which is trading now as positive 0.74, whereas the dollar yen is showing positive 1% and the dollar CAD is showing positive 1.3%. So it's rather mixed bag. We start to see very strong dollar strength coming back into the Japanese yen, at least on the short-term perspective, but rather sideways against the euro dollar, not so much against the Aussie dollar and against the sterling dollar, as these two pair, dollar CAD, the dollar CAD rate and the dollar sterling rate trading below the dollar index. Okay, so this should be the 15th of October. Okay, good. Okay, so with that, now let us now just dive into the picture, the short-term intraday technical outlook on the euro dollar. So no change on the euro dollar as it continues to trade within this range. So during today's yesterday US session, it tested the lower boundary of the neutrality range at 1.089 before trying to bounce up slightly over here. Okay, so still remains neutral as it continues to hover within this range of 1.095 and 1.0890 ahead of this Thursday respective euro dollar risk event, which is the monetary policy outcome of ECB. So we'll touch more about that on Wednesday daily dose, so which is tomorrow daily dose instead, as well as Thursday daily dose. So with that, still remains a neutrality stance of the euro dollar between 1.0950 and 1.0890 for today. Now back to the sterling dollar. So the sterling dollar continues to remain much more firm. It managed to hold a similar low. It came down, can't break below, and traded higher during the later part of the US session. Okay, so with that, still using the 130 medium-term pivotal support level that we highlighted yesterday, this will be my support level. Still maintain a intraday bullish bias on the sterling dollar. First near-term resistance to watch out for will be at the 131.07. Only a breakout with an hourly close above 131.07 will reinforce this bullish bias to seek out the next near-term resistance level at 131.60 next. Only a breakdown of an hourly close below 130 figure level will invalidate today's intraday bearish bias on the sterling dollar. Okay, pardon me, I repeat everything. A bit of tongue twisting. We still maintain our intraday bullish bias on the sterling dollar using 130 medium-term pivotal support level. Price action, near-term resistance level to watch will be at 131.07. This level got to break out on the upside with an hourly close above it to reinforce today's intraday bullish bias to seek out the next near-term resistance level at 131.60, which is this minor swing high area of 4th of October that the sterling dollar can't break out since 4th of October. However, if price action starts to go down and have an hourly close below 130 figure level, which is our medium-term pivotal support, that would invalidate today's intraday bullish bias to see the extension of this ongoing multi-week corrective decline scenario that is in place since 27th of September high to expose the next near-term support level on the intraday basis at 1.2940 and even 1.2860, which is the congestion area of 29th of July, 1st of August, and as well as 14th of August this year. So that's the technical outlook for the sterling dollar. Turning our attention will be the dollar against the Asia Pacific pair, starting with the Aussie dollar first. So the Aussie dollar continues to remains trading sideways above the short-term pivotal support zone that we highlighted yesterday, 0.62, 0.6 figure level. So still no change, still maintain that intraday bullish bias as this support level is not surpassed to the downside. The lower boundary which is 67 figure level that was tested during the start of the US session yesterday. So with that, still maintain the intraday bullish bias with the first near-term resistance to watch at 67.70 figure level. Only a breakout above this 67.70 level may trigger a further intraday bullish bias to expose the next near-term resistance at 68.10, which confluence with the minor swing high of 7th October and the 20-day moving average. However, if price action breakdown with an hourly close below 67 figure level, then that would invalidate today's intraday bullish bias to kickstart the extension of the minor corrective decline scenario unfolding towards the next near-term support level at 66.70 followed by 66.35, which confluence with which is the minor swing low of 11th September and the 200-day moving average. So that's for the Aussie dollar. Now on the dollar yen, so dollar yen yesterday we flipped to a neutrality stance due to mixed element at the 149.30 level and the 148.10 level. So price action yesterday did a bullish breakout above 149.30, and today it came down and managed to actually shape a pullback and bounce off this level again. So we will flip to a intraday bullish bias given that the RSI also remains positive, holding above this parallel ascending trendline support, indicating there is still some form of short-term intraday bullish momentum still at play for the dollar yen. So with that, first support level to watch right now is being tested at 149.40. Slightly below will be at this 148.95. So I'll be using 148.95 as my short-term intraday pivotal support level, 148.95. One short-term pivotal support level. As long as this pullback didn't surpass below 148.95, we'll flip to an intraday bullish bias on the dollar yen. Next near-term resistance level to watch will be at 150.20 followed by 150.90, which correspond very closely to the 200-day moving average. Okay. However, if price action starts to break down below 148.95, that would invalidate today's intraday bullish bias on the dollar yen to see another round of choppy movement. But at least on the intraday basis, we may see a bit of a push down to retest 148.10. A breakdown below 148.10 exposes 147.20 on the dollar yen. Okay, so now turning our attention now will be the major stock indices or US, starting with the Hong Kong 33. So no change on the Hong Kong 33 as it continues to track right now between last Wednesday low and its Thursday intraday high at 21,550. So despite after the Ministry of Finance briefing on Saturday, there was a positive reaction on Monday, but Monday price action can't break above 21,550 for now. So with this kind of sideways movement over here on the intraday basis, I will flip to a neutrality stance instead, given this kind of sideways movement that has taken shape. Okay, 20,525. Okay, so neutral between 21,550 and 20,525. So price action now got to break out above 21,550. Then that could see a bullish exit from this neutrality zone to increase the odds of another round of impulsive up move, at least for the Hong Kong 33. next near-term resistance to watch on the intraday basis after 21,550 is taken out will be 22,320. But however, if price action starts to break down with an hourly close below 20,525, then this corrective move will extend that is in place since 8th of October to seek a retest on the medium-term pivotal support level that is 19,790 slash 19,445, which is correspond to the former minor swing high of 17th of May, and as well as if we do the Fibo extension of this entire short push up from 11th of September that was triggered by this promise of fresh stimulus plan from the China top policymaker, that is the golden ratio of 61.8% that correspond to the 19,445 level. Okay, so that's sum up the intraday technical outlook on the Hong Kong 33. Turning our attention will be the Japan 225 or Nikkei 225. Nikkei 225 yesterday we flipped to a intraday bullish bias, reducing the odds of another mean reversion setback towards the lower limit of a symmetrical triangle range configuration, because yesterday it did a bullish breakout, retest, and managed to survive at the pullback of this former symmetrical triangle range. Resistance now turns into a pullback support level at 39,545. And during the US session, it went up and hit the first resistance level at 40,000 155 slash 40,280. So with that, there are two short-term support level to watch out for today. This pullback line over here, okay, which is at 39,940. So I don't put it so tight at 39,940. I will use 39,545 as my short-term pivotal support level for today, which is exactly the pullback of that former symmetrical triangle range. Resistance now turns into a pullback support. Managed to shape that push up yesterday, all right, during Asia session. So as long as whatever minor any pullback didn't surpass below 39,545, that means no hourly close below 39,545, we will maintain the intraday bullish bias on the Japan 225. Next resistance level to watch will be 40,800 slash 40,990, which correspond to the 0.764 Fibo extension from the low of 6th of September. And as well as this graphical resistance level over here. Okay, former swing low now turns into a pullback resistance on 8th of July and 5th of July this year. Only hourly close below 39,545 means price come down, break down below 39,545. That would invalidate today's intraday bullish bias, and as well as deem as yesterday push up was a failure bullish breakout, and price action may start to see another round of choppy corrective decline to expose the next near-term support level at 38,740, 38,510. Okay, 38,510, which correspond to the rising 20-day moving average as well. So that's for the Japan 225. Turning our attention will be the German 30 or the German X continues to push up within our expectation. Now coming close to our resistance level that we highlighted yesterday, 19,690 slash 19,755. So given that the RSI is now at the overbought level over here, but no clear signs of a bullish bearish divergence, as price action continues to shape a higher high as well over here. So with that, given that it's overbought, there is a risk of a minor pullback. So minor pullback, first support level to watch will be at 19,410 level. Okay, 19,410 level. So that is yesterday's European session low. Slightly lower, this very clear congestion area now turns into a pullback support level. And if you will do the Fibo retracement of the entire rally from 8th of October all the way up to today's Asia session high, that correspond to the 38.2% Fibo retracement as well. So with that, as long as any minor pullback didn't surpass below 19,320, that will be my Titan key short-term pivotal support level for today. We will maintain the intraday bullish bias on the German 30. Next resistance level to watch after 19,755 will be at 19,930 next, which is the 0.654 Fibo extension. okay, 0.764 Fibo extension from the low of 11th of September. However, if price action pullback and have a hourly close below 19,320, then today's intraday bullish bias will be invalidated to trigger a much more deeper minor corrective decline scenario unfolding to revisit 19,130, which correspond to the rising 20-day moving average. A breakdown below 19,130 exposes the minor swing low area of 8th of October and 4th of October, acting as a next near-term support level at 18,960. So that's for the German 30. Now, turning our focus now will be the major US stock indices, starting with the US Wall Street 30, i.e. the Dow Jones Industrial Average. Bounce hit our first resistance at 43,170 before trading sideways. RSI overbought, but there's no bearish divergence as price action continues to trade a series of higher high over here. Okay, no bearish divergence, no clear bearish divergence. So what we could see is that it's an overbought. There's a potential chance of a minor pullback. So minor pullback, first support level to watch out for with this minor swing higher now turns into a pullback support of 42,940. As long as it didn't surpass this very clear former range resistance that was in place since 27th of September, come break during 10th of October and finally broke out on last Friday after the very strong JP Morgan earnings results that surpassed expectation easily. This level here will be an inflection point for the bulls to maintain. So tighten our short-term pivotal support for today on the US Wall Street 30 to 42,630. As long as this level holds in any form of money pullback, we will maintain that intraday bullish bias on the US Wall Street 30. Next resistance level to watch out for will be at 43,920, which is correspond to the upper limit of this minor ascending channel that I drew from the low of 5th of August, and as well as the 1.236 Fibo extension taken from the low of 5th of August as well. However, if price action starts to have an hourly close and a breakdown below 42,630, that would invalidate today's intraday bullish bias on the US Wall Street 30 to trigger a minor corrective decline scenario to extend it further towards on the downside to expose the next near-term support at 42,180/41,950, which correspond to the rising 20-day moving average and as well as the lower limit of this minor ascending channel that I drew from the low of 6th of August, okay, 5th of August, pardon me. Okay, so that's for the US Wall Street 30. Now, turning our focus will be on the Nasdaq 100. So Nasdaq 100 also pierced up and hit our first resistance, almost coming close to the second resistance at 20,615. So with that, the hourly RSI has now hit the overbought level and reintegrate back in below the overbought level, hovering around the 63 level mark over here. So there is a possibility that it may shape a minor corrective pullback towards the former range swing high of 26th of September, tested on last Thursday before it traded sideways, and finally it did that bullish breakout on yesterday. Okay, now turns into a pullback support. So this will be the first support level to watch in any case of a minor pullback, given that the RSI has really reintegrate below the overbought zone. So 20,360 first support level to watch. Pivotal support for today will be last Friday swing low that has been tested several times on Thursday as well. So 20,150. So 20,150 will be my minor short-term pivotal support for today to maintain our intraday bullish bias on the Nasdaq 100. Above 20,615 will potentially retest the current all-time high at 20,790 that was printed in 11th of July. However, if price action starts to shape a breakdown with an hourly close below 20,150, then this intraday bullish bias will be invalidated to potentially see a deeper minor corrective decline to revisit 20,000, which is the rising 20-day moving average. Failure to hold 20,000 potentially exposes the next near-term support zone at 19,750/19,630, which confluence also very closely to the lower limit of this medium-term ascending channel in place since 5th of August. Okay, so let's sum up the intraday technical outlook on the major stock indices. Okay, now with that, let us now turn our attention to the commodities market. over here, starting with gold XAU/USD. So for gold XAU/USD continues to trade sideways yesterday, but still holding above the 20-day moving average. Okay, so no change, still using that 2627 as my short-term pivotal support level. Still maintain the intraday bullish bias on gold XAU/USD. First resistance level to watch will be the current all-time high area at 2674/2684. A breakout above 2684 potentially sees the next near-term resistance coming in, defined by a cluster of Fibo extension level 1.382 and 1.382 from the low of 4th of September and 1.382 from the low of 25th of July. So that actually form a cluster at 2709 and 2719. Only an hourly close with a breakdown of hourly close below 2627 that would invalidate today's intraday bullish bias on gold XAU/USD to kickstart another round of a choppy minor corrective decline in first step towards 2605/2590. Now, turning our attention will be the West Texas crude oil. So West Texas crude oil, yesterday we do have a bullish bias at 73.15, looking for a bounce back up at least to 76.70, followed by 78.30. However, price action broke down below 73.15 due to that very lackluster demand outlook report up from OPEC. So that actually invalidate the intraday bullish bias. So potentially we could see some form of range trading again back towards the lower boundary of the range. So with that, using yesterday's high, US session high, 75.30 level. So 75.30 will be my short-term pivotal resistance level to watch. First resistance will be at 73.15, yesterday breakdown level. As long as this minor whatever pullback rebound didn't surpass 75.13, that is our short-term 75.30, not 13, 75.30, that's our short-term pivotal resistance. We will flip to an intraday bearish bias on the West Texas crude oil to look out for the lower limit of that range at 71.10 and 68.70 next. So if we will do the Fibo retracement of that previous rebound from the low of 1st of August all the way up to the high of 8th of October, due to the aftermath of that Middle East tension or increasing tension, that also corresponds to the 76.4% Fibo retracement, which is the 71.10. However, if price action starts to break up above 75.30, then potentially we could invalidate the intraday bearish bias to see it pushing up to the top upper limit of the range again. First resistance to watch will be at 78.30, followed by 80.30 next. So that's for the West Texas crude oil, and that also sum up the intraday technical outlook on the broad-based cross asset classes. So before we go, let's take a look at the calendar. What are the key data to look out for today? So today will be Tuesday. So during the European session, one key data to look out for at 2 p.m. will be pertaining more to the sterling dollar, which is UK unemployment rate for the month of August and unemployment change at 2 p.m. Singapore time. Then thereafter, we do have Eurozone economic sentiment data out at 5 p.m. They call it the ZEW Economic Sentiment Index for the month of October. All right, so market consensus is expecting a slight, in fact, a significant recovery on previous September print of 9.3, expected to recover to 16.9. Then thereafter, pertaining to more to the Canada dollar for those who have an interest. So at 8:30 p.m. Singapore time, we have the inflation rate out from Canada. Then during the US session, will be rather quiet. We do have one US Federal Reserve official speaking, Fed Daly speaking at 11:30 p.m. Singapore time. And at 1 a.m., we do have Fred Kruger speaking as well. And in early tomorrow Asia session, pertaining more to the Kiwi dollar, we do have at 5:45 a.m. New Zealand inflation rate for Q3, and at 6 a.m. Singapore time tomorrow, pertaining more to the Aussie dollar, we have a RBA official Hunter speaking. And before we go, as I mentioned, today we are still in the midst of the first week or the first 1.5 week of the US earnings Q3 reporting season. For today, before the start of the US session, we do have very important US company reporting that Q3 that has significant weightage on the Dow Jones Industrial Average, which is the remaining of the major US banks. and as well as United Health. So this will come in before the start of the US session. Okay, so United Health is the #1 biggest weighted component stock on the Dow Jones Industrial Average reporting today, then followed by the 3 major US financial institutions or Bank of America, Goldman Sachs, and Citigroup. They will report their respective Q3 earnings result before the start of today's US session. So that's something to take note of as well. So with that, that sum up today's Daily Dose of Market Insights. I'm Kelvin here signing off, wishing you all a great and wonderful day ahead. We shall speak again tomorrow. Thank you.